Welcome back, Curiosity Crazers. Today, we're diving deep into the world of investing with the Oracle of Omaha himself, Warren Buffett. But stick around until the end because we've got a mind-blowing secret that could revolutionize your investment strategy. Warren Buffett, the CEO of Berkshire Hathaway, is arguably the most successful investor of all time. With a net worth of over $100 billion, his investment principles have become the gold standard in the financial world. But what makes Buffett's approach so effective? Let's break down his 5 golden rules that have led to his extraordinary success. Rule number 1, value investing. Buffett learned this principle from his mentor, Benjamin Graham, and it's the cornerstone of his investment philosophy. Value investing is all about finding undervalued companies with strong fundamentals. Buffett says, "Price is what you pay, value is what you get." He looks for companies trading below their intrinsic value, which he determines by analyzing factors like cash flow, assets, and earnings potential. For example, in 1988, Buffett saw value in Coca-Cola when others didn't. He invested $1.3 billion, which is now worth over $25 billion. That's the power of value investing. Rule number 2, long-term perspective. Buffett famously said, "Our favorite holding period is forever." He believes in buying great companies and holding on to them for the long haul. This approach allows him to benefit from compound interest and avoid the pitfalls of short-term market fluctuations. Take Buffett's investment in American Express. He first bought shares in 1964 and has held them ever since. Today, Berkshire Hathaway's stake in Amex is worth over $25 billion, showcasing the power of patience and long-term thinking. Rule number 3, stay within your circle of competence. Buffett strongly believes in investing in what you understand. He calls this your circle of competence. This principle has led him to avoid trendy tech stocks and stick to industries he knows well, like insurance, banking, and consumer goods. For instance, Buffett has largely stayed away from tech stocks, admitting he doesn't fully understand them. However, he made an exception for Apple in 2016, only after thoroughly studying the company and recognizing its strong brand loyalty and ecosystem. Rule number 4, margin of safety. This principle is all about minimizing risk. Buffett always aims to buy stocks at a price well below their intrinsic value, providing a margin of safety against potential losses. He once said, "Rule number 1, never lose money. Rule number 2, never forget rule number 1." This focus on preserving capital has been crucial to his long-term success. Rule number 5, be fearful when others are greedy, and greedy when others are fearful. This contrarian approach has helped Buffett capitalize on market downturns. During the 2008 financial crisis, when most investors were panicking, Buffett invested billions in companies like Goldman Sachs and General Electric, securing favorable terms and making substantial profits as the market recovered. Now, you might be wondering, how can I apply these principles to my own investing? Well, let's look at how another investing legend, Peter Lynch, put some of these ideas into practice. Peter Lynch, who managed the Magellan Fund at Fidelity, delivered an astounding 29% annual return over 13 years. Like Buffett, he emphasized investing in what you know, aligning with the circle of competence principle. But here's where it gets really interesting. While these principles are crucial, there's one secret that Buffett uses that most people overlook, and it's this secret that we'll reveal at the end of our video. Trust me, it's worth the wait. Before we get to that, let's address a common misconception. Many investors believe that diversification is always the key to success. However, Buffett has a controversial take on this. He once said, "Diversification is protection against ignorance." It makes little sense if you know what you are doing. This doesn't mean you should put all your eggs in one basket. Rather, Buffett suggests that if you've done your homework and truly understand a company, you can invest more heavily in it. It's a high risk, high reward strategy that's not for everyone, but it's how Buffett built his fortune. Are you ready for the secret? The mind-blowing tidbit that could revolutionize your investing approach? Warren Buffett's secret weapon is extreme patience, but not just any kind of patience. Buffett practices what he calls extreme patience. He's been known to wait years, even decades, for the right opportunity to invest. In fact, Berkshire Hathaway once held over $100 billion in cash, waiting for the right investment opportunities. This extreme patience allows Buffett to capitalize on rare, high-value opportunities that others might miss. For example, during the 2008 financial crisis, Buffett's patience paid off. He was able to invest $5 billion in Goldman Sachs on incredibly favorable terms because he had the cash available and the patience to wait for the right moment. So, there you have it. The secret sauce behind Warren Buffett's incredible success isn't just about picking the right stocks. It's about having the discipline to wait for the perfect moment to invest. It's a principle that goes against our instant gratification culture, but it's one that has proven incredibly effective. Remember, investing isn't about getting rich quick. It's about making smart, informed decisions and having the patience to let your investments grow. Whether you're just starting out or you're a seasoned investor, these principles can help guide your investment strategy. And that's it for today's Curiosity Craze. If you found this video helpful, don't forget to like, subscribe, and hit that notification bell, and let us know in the comments, which of Buffett's principles do you find most intriguing? Until next time, stay curious.